But we have to start with Robert's question. He was first, okay? So, not necessarily an easy question to answer. I've read through part of it, but it's a long question, so just bear with me, everyone, while I read it. And while you're waiting for me to read it, we'll just go to Iron Condors here. It's Robert, right? Why was I thinking Ronald? Sorry, there it is, Robert. Excellent. Okay, so Robert's was the first question that came in. It says, I would appreciate some expanded discussion of option probabilities. Okay, hold on one second. I'm going to try to expand my screen that you guys aren't seeing so I can read this better. Okay, discussion of probabilities. Relative to Iron Condors especially, using index options such as the SPX Black-Scholes uses Gaussian distribution model. From what I've read, understand, and experience, options do not necessarily follow that, but rather a skewed distribution. So the probabilities for associated puts and calls are skewed. Okay, I can see what you're saying there, but it's not really the same thing as Black-Scholes. Okay, the probability equation is not the same thing as Black-Scholes. And you say, also, is there a whole issue of what probabilities to set the short strikes to achieve specific OTM probability? One want to sell an Iron Condor on SPX with a 90% probability. Where would he set the strikes and at what probabilities? Okay, so probability in the Iron Condor, the theoretical probability between. Is this part here, Robert, is simply a mathematical equation that's taking into account what? Let me go back to the main home. The probability between is looking at the probability that the stock would remain above the short put, but not above the short call. Okay, we know the probability above the short put. We know the probability the stock would be below the short call. It's already calculated. I know that's the first part of your question. I'm skipping towards the end, but we'll go back. So we know all two probabilities, probability above and below for our short call and our short put. This equation then takes those numbers into account and says what is the likelihood based on those numbers that over the next X amount of days the stock is going to remain between the strike prices, not be above the short call, but not be above the short put. So it's taking those four probabilities that are calculated, and at that point it's just a mathematical equation to determine the likelihood of it being between. Okay, now the probabilities themselves take into account some of the same calculations that is used in the Black-Scholes pricing model. But that's not necessarily what probabilities differ, a little bit different than the Black-Scholes. Essentially what the probability is stating that based on the past X amount of trading days of the stock, what the stock has done, including volatility, one of the factors in the Black-Scholes, but what the stock has done in the last, 50, 60, 100 days or so, what is the likelihood that it's going to be at or above or at or below X price in the next 10, 15, 20, 30 days or more? Okay, that's what it's looking at for the equation. I'm not going to give you the full equation itself. I can have Ernie email that to you. He has an old file that he has it written out somewhere. But it's a standard equation that's used by many options investing services. It is similar to how Black-Scholes and how delta is calculated, but it's not exactly the same. It just uses some of the same features, okay? Same numbers. But that's what probability is. It's based on the past trading range of the stock, which takes into account the volatility, which is used in the equation. What is the likelihood that the stock would be trading at X or Y in the next X days, meaning the days you're selecting to expiration? So naturally, when you look at strike prices of options, you take SPY, you take SPX, you take anything, and you look at the $50 strike for 1 week out for next Friday's expiration, you might have an 82% probability. The stock's trading at 47, the 50 strike might have an 82% probability of being below. The 50 strike call, excuse me. The next week out might only be at 79%. The next week out might be at 76 with the same 50 strike. Okay, it's lowering as you go further out in time because there's more time for the stocks to fluctuate against us. All right, but that's effectively what your probability is. I'm not going to go in depth into the equation. Now, what are good settings to use for the Iron Condor to find a probability? Best. I'm going to give you an answer, but the true answer is whatever you're comfortable with, whatever matches your risk requirement. On the search, we give you just about every probability you could use. The probability above the short put break even. The probability just above the short put strike price. Hey, I might set that to 80 or 83%, even on SPX or SPY. probability below the short call. Just if I was doing a bear call, I might set that at 80 or 83. And then the probability between, I might set at 82 or 83. Okay? So what am I looking for here? Anything that has an 83% higher probability between, but where the range out of the money on the bull put side and the bear call side individually would have an 83% probability of the stock not dropping below the short put or rising above the short call. Okay? So that's just an idea. I don't know what you're comfortable with. Now you have to ask, do the returns and the credits match your requirements? That also comes down to the time frame. You had mentioned SPX. So Robert, it's likely you might be trying to do the Monday, Wednesday, and Friday series that are offered. I'm not going to give you any advice on that because I've never traded them and I've never looked at them. Okay? I know a lot of people got burned, and it's not our fault. It's not anyone's fault. It's not any options provider's fault. But just like we talked about with Charlie, with the 5 married puts that he was paper trading at the beginning of August, and only one of them looks like it has an income method, well, that was a curse of the market. Anyone who opened a 5-day out or 2-day out SPX or SPY Iron Condor, bull put credit spread or bear call credit spread with an 80%, well, I'm sorry, let me rephrase that. A bull put credit spread or an Iron Condor on SPX, whether it was 1 week out, whether it was 2 days out using the Monday, Wednesday, Friday series, if you opened it on August 1st and had an 83% probability, you still lost on the bull put side. That 600-point drop. Charts can't see that. Probability can't see that. No one can see the unexpected black swan event. No chart can show that. You can get a feeling, as Sam mentioned, that says, oh, we've been hitting new highs. Maybe now is not the time to do a bull put credit spread or an Iron Condor. That's a gut feeling. The probability can't tell you that. Okay, it can't tell you that now that we've been bumping off the ridge here of the top, should we skew the probability to the put side because a fall is kind of likely based on what's happened? No. We try to show that in the market sentiment tool on PowerOptions, where it takes into account the 13 factors here, the 13 different indicators, so that when we do start hitting new highs, you might see a sell warning or a strong sell warning. Okay, that has happened recently in the past before a sell-off triggered. Not because of a political or outside announcement news headline that caused the Dow to drop 600 points. You wouldn't see that in probability. You wouldn't see that on your stock charts. Simple as that. Okay, so that's the best way I can answer your question there, Robert, on the Iron Condor positions and the probability. If you want more information on what the calculation is, you can just send us an email to support@powerop.com. I'll see if Ernie can get that sent to you there as far as what the actual probability calculation is as well. But that's what we look at when we talk about the probability position. Okay. Oh, sorry, I went the wrong direction. Let me go back up to the top here. And yeah, so Robert, I'm saying these numbers here. Now, let me clear this out. Let me leave the expiration date to next week, any weekly for next week. So let's go 1 day to 9 days. And for the stock list, I'm just going to put in SPX. And now I'll go back to the options filters here, and I'm going to do what I said. I'm going to put in 83s, okay? This 83 number is also going to relate, I think, to our next question. And so I've got 600 results. Everything was 7 days out, 5 days out. Further down the list, there's probably 3 days out. I didn't put anything for open interest, range out of the money, or anything, because I've focused on the probability. Well, some of these right now, I can tell you I don't like. This one here, SPX is now at 3,007. Using the 2920 short put. I think that's kind of close. 3060 short call. It's probably still a little bit close. I'd want to be further out of the money, maybe with a higher probability in this case. But again, it depends. So what I'm trying to show you here is just, it's not just about the probabilities. Does this match the returns that you want? All right, so you can go higher in this time frame. We could go to 90s, right? And you go up to 90s, Robert. But then we're going to look at the net credits real quick, and we're going to look at the returns for 7, 5, 3-day trades. I'm not sure this is the match you want. Yeah, 9%. That's still pretty good. If you think about it, it's good for a 1-week trade, but it's 45 cents on a 5-point spread. Okay, it's still 9% with a 90% probability. But again, there's a lot to choose from here. And yes, if we shortened it, let's go to 6. You'll see the 5-day trades with almost the same net credit here, but the difference is it's closer, right? Still a 90% probability, still a 9.9% return, but now you're at 29.50, only a 50-point movement. And you're at 38.5 is pretty good on the upside there for the call. So again, that's kind of interesting. Okay, so I can't give you direct advice on the SPX, especially if you're using those shorter terms, because I've never traded them. I've never researched them. In general, when I do credit spreads, I go 14 days out in time. And yes, I look at that 85% probability. Okay. All right. Next question that came in live from Edison. Hi. For $1 wide credit spread with 30 cents premium giving us about 70% probability, should it matter if we are closer or further out of the money, assuming the same width spread and premium? And we still have a 70% chance. Same goes for closer or further out in time. How do we all take this into consideration? Okay, kind of just explained it a little bit. First off, I can't pull up the slides right now. I think I have them here somewhere on my desktop. But I've shown time and time again during our credit spread discussions and in the archived credit spread webinar. I believe it is either, it's either Credit Spreads, the Basics, which I think it's in there, or Beyond the Basics Part 1. Structure, effects of strike difference, spread, and underlying criteria. Okay, I think it's in Credit Spreads, the Basics. What I effectively show here is that if you're doing any bull put spread, bear call spread, or Iron Condor, your target probability should be 80% to 83%. Yeah, you could get 30 cents on maybe a $1 wide credit spread with a 70% probability. But in this, I show the comparison of what happens when you use bull puts with the proper probability, 80, 85%, versus when you're using a 70% probability. The 70% loses more often than not long term. 75% loses. Even though you're getting a higher net credit, you're taking much higher losses on a regular basis because you're not as far out of the money. Testing I did in all of 2018, same option criteria, same underlying stocks, same time frame, and different time frames. You had better profits over the course of a longer time horizon with an 80 to 85% probability than even though you might be making close to a 30% return with a 70% probability compared to only a 12% return on average or 15% return on average with an 85. You were successful more often. Looking for a 70 to 75% probability, you actually have to be right 78% of the time. If I'm looking for an 85% probability, I have to be right only 82% of the time. But I've put myself in that structure. We've shown that mathematically time and time again. So I'm saying that because, to start with, because Edison, I don't necessarily think you should be looking at 70% probability spreads, regardless if you're getting 30 cents on a $1 spread, because over a longer time horizon, I've seen that fail time and time again. It doesn't produce profits. It didn't. You lose too much, and even though you're taking in a higher net credit, you're wiping out more trades. You need to be right more often, okay? Now, your direct question was, though, if you've got this 30 cent spread on 30 cent premium on a 1-point spread with a 70% probability. Should it matter if you're closer in or farther out of the money? Well, that goes back to what we just defined about probability. The one stock that has a 30 cent net credit on a 1-point spread with a 70% probability and is further out of the money is probably more volatile. Okay? Meaning that it has a higher volatility. It's been fluctuating more, so you're a few strikes below the stock and still getting that 30 cent premium between these $1 strikes. It probably has more volatility. Similar stock, okay, similar price stock, but you're only half a strike in the money with a 70% probability, and it's probably because it's been moving up more gradually. There's less likelihood that it's going to fall to that next strike level. So that's probably the difference, is a volatility. And then you have to ask yourself, is it worth it to trade that position at all with a stock that has the higher volatility, because that's not what you want for a credit spread, okay? Think about this for a minute. I'm going to try to do a visual example. Okay, we're going to try to create the search. And then, of course, you mentioned further out in time. Well, now you're giving yourself more time for the spread to move against you. Okay, so is it worth it to do that? Okay, here's what I'm going to try to do. We're going to set our expiration time frame to next week. 0 to 8 days. We're going to keep the probability close, 70 to 75. A strike difference of equal to 1 and a net credit of at least 29 cents. Okay, there's a lot in here. Let me do something else here. Sorry about that, folks. This one I will put in some liquidity because I immediately saw that some things there were out of bounds with a wide bid-ask spread. I should have put a bid-ask spread in. Okay, we'll leave it there. If you get the midpoint, yeah. So you're talking about a 48% return with a 70% probability. These are all similar stocks. First off, throw this one right out the window. Never use a 3 times ETF on a credit spread. That's this close. That has a 70% probability is this close to the money. No, you wouldn't do that. Okay, the VIX, one of the VIX ones, that's questionable too. Okay, let's just take, there's both of them beyond meat. I'm sorry, 71, 78, okay. Overstocks at 24. Okay, let's take a look at the last two. Not very similar prices for the underlying. But Overstock at 24, LVS at 59. Okay, so on Overstock, I'm going to be selling the 21.5. So I'm 3 points and 80 cents out of the money. And on Las Vegas Sands, I'm only 1 point out of the money. 59.34 is at 58 strike. So there's a 71.9% theoretical probability LVS would be above 58 in the next 7 days. Man, that's close. It already dropped 81 cents today. Okay? Not to say it's going to drop 81 cents tomorrow, but if it does, you're probably right at your stop for that position. So in this case, I'd say it's safer to go with this one that's deeper out of the money. Overstock is 21.5. I haven't looked at Overstock in months. I have no idea what it's been doing. So if I look at that stock chart and I see that Overstock has been bouncing around, even though that it has the probability, it's such a close trade with such a low probability. In my opinion, that's low. I'm sorry, in my opinion, that's low. Okay, so we had big dips down here in August with everything else. Another big dip down here at the end of August, down to the 15 level. Earnings or something propelled this back up, but it has dropped from 30 down to 25, 5 points in the last day. This thing I'm not interested in doing a bull put spread on right now. I'll be honest with you. Let's go to a shorter 1 month chart so you can see that a little bit better. There's that wild dip, the end of the wild dip, and then it shot up today to almost 30 and ended right at about 25. Maybe earnings was today, but there's this nice ramp up to it and then this huge spike down. Okay, this doesn't look to me something I'd be interested in doing a bull put spread that's even 2 points or 3 points away from the current price. Too much fluctuation going on here in this case. That's a warning sign to me, okay? Does that mean Las Vegas Sands is necessarily better? I don't know. That's really close. And I'm giving you this comparison because it's only 7 days out. If I went to Las Vegas Sands, let's go to that search by symbol again for the bull puts. But let's go to, there's September. Okay, there's that 7-day series. But if I go out to October, and here's that further out in time, where's my 42% return? Here it is. It's on a 2.5 point spread, though. The probability is only at 62.5. Okay, so now when you get to the 70 range that you were looking for, you're closer to only the 19% return, not the 48% return you were looking at. Okay, so the best way I can answer this question in relation to that is that I wouldn't be looking at the 70 percentile. I think that's too low, and I've seen just consistently at not profit long term. And which one is better? Well, it's the one that probably gives you the most comfort as far as how far it is out of the money. You know, what is your market expectation in that case? Okay, let's see here. Okay, Sam, I'm going to get to your comments on bull put ideas in just a second. This comment here I think I wanted to add in earlier, but we'll add it now. Sam, I believe you said that one has to work out how many times the market drops and how many times the market goes up. There will be a big drop once in a while, a fret that market slowly goes up. Yeah. Any of you who have been following me over the last 12 months or so, you remember the recap in 2018. that bull put discussion on credit spreads, the basics and beyond the basics, where I talk about how that 70% probability and 75% probability on the same stocks with the same structures with that higher return didn't work out, whereas looking for an 83% was profitable. And that was in 2018, where 6 of the 12 months were negative. It was half and half if you look at it. Okay? And that's sort of the phrase there. Okay, Jerry, okay, that's the end of that. Jerry has 2 questions here. One I don't think I can answer during this webinar, Jerry. Let's risk to make money. Okay, I'm sorry, Sam, you had made a comment. It was probably in relation to that as well. You just said no need to risk money. It could be low risk or high risk. You cannot get rid of risk. Yeah. Inside a bull put spread, I think we were talking about that 70% probability there as well. Oh, and you don't do the good call. You don't do the call side, Sam, selling the calls against those triangles. You just use the put.